Hey everyone, and welcome back to the Gold Too Long Didn't Read. Guys, the timing of today's video is special because it's the very last day of 2025. First, I want to send a huge thank you to every trader watching right now. I truly appreciate the likes, the support, and you sticking with me on this journey. Tomorrow is New Year's Day, so I'm wishing you all a Happy New Year in advance. May 2026 bring you health and financial freedom. May every trade take you to the moon. Let's get there together. Alright, today's video is our official annual wrap-up of the gold market. Have you checked your profit and loss for the year yet? If you've been holding gold, you're probably sleeping like a baby right now, aren't you? We started the year at $2,600 and skyrocketed to $4,550. After Christmas, that is a massive 70% gain. Think about that for a second. We're not talking about Bitcoin or some pump and dump meme stock. This is gold, the ultimate store of value for thousands of years. This has been the wildest, most aggressive year for gold since 1979. We are literally witnessing history. Those of you with sharp instincts and maybe a little luck caught a once-in-a-lifetime wealth train. But even with all the celebrating, I know what you're secretly wondering. It's up so much. Is it too late to buy in 2026? Is a crash coming? Am I going to be the one left holding the bag? Don't sweat it. Today, I'm going to break down this epic 2025 gold bull market with total precision. We aren't just looking at that it rose, but why it rose. Because if you understand the why of the past, you can unlock the wealth codes for 2026. Ready? Buckle up, hop into the time machine, and let's go. Let's rewind to January 2025. Remember the vibe? Donald Trump had just returned to the White House, and the market was on edge. Gold was hovering around $2,600. Most people were hesitating, wondering, is gold out of gas? Is the dollar about to rally? It was like meeting a crush for the first time you're interested, but you're too scared to make a move. January and February were essentially the accumulation phase before the storm. The Trump administration started moving on campaign promises, threatening tariffs on Canada, Mexico, and China. The market was actually pretty slow to react at first. Gold just moved sideways between $2,600 and $2,800, which drove short-term traders crazy. The dollar was still acting tough, which kept gold prices suppressed. But then, everything changed in March. As the tariff policies became real, the market suddenly realized a scary truth. This wasn't just a trade spat. The whole global game was changing. Because of that, March 14th went down in the history books. Gold broke the $3,000 mark for the first time ever. Why is $3,000 such a big deal? It's not just a round number. It represented a total loss of faith in fiat currency, the paper money in our pockets. The Fed hadn't even cut rates yet, but investors didn't care. People weren't buying gold to get rich. They were buying it to survive. It was like everyone rushing for lifeboats before the Titanic hit the iceberg. By March 18th, gold held steady above $3,000, and the $2,000 era was officially over. If you weren't in by then, the FOMO was probably killing you. Moving into the second quarter, the nuclear bomb dropped. On April 2nd, President Trump signed Executive Order 14257, which the media called the Liberation Day tariffs. Sounds nice, right? But for the financial markets, it was more like Judgment Day. The U.S. slapped a 10% baseline tariff on almost all imports, and for 57 specific countries, a massive 50% reciprocal tariff. Imagine walking into a store and seeing everything 10% to 50% more expensive overnight. That's structural inflation. The market went into a tailspin. Global supply chains broke down and stocks tanked on recession fears, causing a liquidity crunch where everyone sold everything for cash. Gold actually dropped nearly $200 in 3 days. But as soon as that panic selling stopped, fear of inflation and a weak dollar gave gold its shining moment. From April 9th to April 22nd, just 9 trading days, gold shot up over $500 an ounce, smashing through the $3,500 ceiling. At this point, the old market rules were out the window. Usually, high interest rates make gold fall. But this time, that model broke. It was replaced by the stagflation trade, zero growth plus high inflation. The people buying gold now weren't just retail traders. It was the smart money, the big institutional sharks. They knew inflation was no longer temporary, and that holding cash was like holding a melting ice cube. However, by May and June, the market needed to catch its breath. After hitting $3,500, prices pulled back and consolidated, ending the quarter around $3,300. This was a fascinating period because the physical market split. Traditional buyers in India and China saw the high prices and backed off, so jewelry sales dropped. But investment demand for gold ETFs and coins surged to fill the gap. What does this tell us? This wasn't about jewelry anymore, it was a pure big money move. After a quiet summer, gold got a second wind in the third quarter. In July and August, it moved sideways between $3,300 and $3,400. I know a lot of beginners got shaken out then, thinking the run was over. But let me tell you, this kind of high-level consolidation is just the big players switching positions. It's like a race car taking a pit stop to refuel for the next lap. In September, the man who controls the world's money, Fed Chair Jerome Powell, finally blinked. Facing pressure from tariffs and a weak job market, the Fed announced a 25 basis point rate cut on September 17th. Even though inflation was still high, Powell was terrified of a hard landing, a bad recession. This insurance cut was the spark the gold bulls needed. Now, here's the most important part. We have to talk about the biggest buyers, central banks. According to the World Gold Council, central banks bought 220 tons of gold in Q3 2025 alone. Even at record highs, they were clearing the shelves. China's central bank increased its gold reserves for 13 straight months. The signal here is loud and clear. When entire countries are dumping dollars for gold at any price, it means we are in a war for financial sovereignty. Have you noticed the shift? Central banks used to buy gold to balance their portfolios. Now they buy it for self-defense. After seeing how the U.S. can use the dollar as a weapon, gold, the only currency that no government controls, became the ultimate safe haven. Between the Fed cuts and the central bank shopping spree, gold hit $3,900 by the end of September. The party was just getting started. Entering the fourth quarter, things got intense, borderline suffocating. In October, gold blasted through the $4,000 barrier. $4,000, guys. Who would have believed that a few years ago? This wasn't just breaking a technical level, it was breaking the limit of what people thought was possible. But just as it was eyeing $4,400, we saw a massive shakeout in late October. Prices dropped nearly $500 as rumors of U.S.-China trade progress and a Russia-Ukraine ceasefire hit the wires. However, because Trump appointed a dovish, pro-low-rates Fed chair, expectations for more rate cuts kept the floor solid. Prices stabilized and bounced back fast in November. In December, gold went absolutely parabolic. This time, it was a black swan event, the U.S. naval blockade of Venezuela. Trump ordered the blockade to choke off oil revenue for Maduro. We even saw U.S. Special Forces seizing tankers. Venezuela didn't back down. They sent their navy to escort ships, and rumors of drone strikes started flying. This was happening right in America's backyard, and geopolitical risk went through the roof. Global capital panicked, and money poured into gold as a hedge against a potential war. At the same time, gold's little brother stepped up to help silver. In November and December, silver had an epic short squeeze. It was simple. The solar power industry needed silver, and there wasn't enough to go around. Then, China restricted silver exports, starting the 1st of January 2026, causing a global hoarding panic. Even Elon Musk tweeted that high silver prices were bad for business. Silver briefly hit nearly $84. Gold and silver usually run together, and silver's explosion dragged gold even higher. On December 26th, right after Christmas, gold hit an all-time high of $4,550. It was the emotional peak of the year and another massive milestone for financial history. Shortly after, the CME, the big exchange, raised margin requirements, making it more expensive to trade, and investors started taking profits for the holidays. Gold pulled back to about $4,350, finishing the year up over 65%. Now that we've reviewed this crazy year, let's take a breath. What is actually driving this bull market? I think one sentence from this report says it all. Gold has evolved from a defensive safety net to an offensive strategic asset. We used to buy gold to hide from inflation. In 2025, the game changed. First, protectionism is the new normal. Globalization is over, which means inflation is here to stay, and your paper money will continue to lose value. Second, there is a quiet death of trust in the dollar. When the U.S. can blockade a country at any time, other nations are scared to hold only dollars. De-dollarization isn't just a theory anymore, it's a reality. Third, central banks don't care about the price anymore. They care about security. As long as it protects their national wealth, they don't care if gold is $4,000 or $5,000. What do you think? Drop a comment below. Has gold officially reclaimed its crown as the king of currencies? So, the big question, what do we do in 2026? Looking ahead, the smart money on Wall Street is surprisingly on the same page. They are incredibly bullish. JP Morgan is calling for $5,000 gold by the end of 2026, with a long-term target of $6,000. They think the central bank buying is just getting started. UBS is even more aggressive, saying that if political drama heats up like chaos during the midterms, $5,400 is totally possible. Bank of America is also targeting $5,000. Sounds like a sure thing, right? Like you can just buy with your eyes closed and get rich? But I have to play devil's advocate for a second and talk about the risks. Listen up, because this is vital. Even though the big trend is up, we are facing some huge short-term speed bumps. First, the World Gold Council has warned about a reflation risk. If Trump's policies actually make the U.S. economy boom, the Fed might have to raise rates again to stop inflation. If that happens, gold could see a 5% to 20% correction, potentially dropping back to the $3,360 or $3,990 range. Second, don't forget what I've said before. In January 2026, the Bloomberg Commodity Index bcom rebalances. This could trigger a lot of automatic selling. So gold in 2026 probably won't be a straight line up. It's going to be a bumpy ride with plenty of fake-outs. Finally, some advice for 2026. If you're a long-term investor, the big picture is clear. As long as countries are moving away from the dollar and global tensions are high, gold will remain valuable. Every big dip is likely a buy-the-dip opportunity. $4,000 is now strong support, and $3,500 is likely the floor. But if you're a short-term trader using leverage or CFDs, be extremely careful. The volatility will be insane. Don't get liquidated, wept out, right before the next big move. It's like surfing. The bigger the waves, the more fun it is, but the easier it is to get crushed. Managing your risk is the #1 rule for staying alive in this market. All right, that's my wrap-up of the 2025 gold bull market. We've been through a lot this year, and I hope these videos have helped you make sense of the chaos. If this was helpful, please show some love and hit that like button, subscribe to TLDR, and turn on those notifications. For the new year, I hope all your trades hit their targets and you make the gains you've been counting on. I'm the Gold TLDR, and I'll see you in 2026. Later.